Ladies and gentlemen, good afternoon. Welcome to the press conference at the ECB after the Governing Council meeting that just finished. I'm joined here on stage by President Lagarde and by Vice President de Guindos. My name is Wolfgang Preußel, and I will now hand over to President Lagarde. President Lagarde, please.
Thank you very much, Wolfgang. Well, ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of the meeting of the Governing Council, which was also attended by the Commission Executive Vice President, Mr. Valdis Dombrovskis. After the contraction in the first quarter of the year, the euro area economy is gradually reopening as the pandemic situation improves and vaccination campaigns make significant progress. The latest data signal a bounce back in services activity and ongoing dynamism in manufacturing production. We expect economic activity to accelerate in the second half of this year as further containment measures are lifted. A pickup in consumer spending, strong global demand, and accommodative fiscal and monetary policies will lend crucial support to the recovery. At the same time, uncertainties remain, as the near-term economic outlook continues to depend on the course of the pandemic and how the economy responds after reopening. Inflation has picked up over recent months, largely on account of base effects, transitory factors, and an increase in energy prices. It is expected to rise further in the second half of the year before declining as temporary factors fade out. Our new staff projections point to a gradual increase in underlying inflation pressures throughout the projection horizon, although the pressures remain subdued in the context of still significant economic slack that will only be absorbed gradually over the projection horizon. Headline inflation is expected to remain below our aim over the projection horizon. Preserving favourable financing conditions over the pandemic period remains essential to reduce uncertainty and bolster confidence, thereby underpinning economic activity and safeguarding medium-term price stability. Financing conditions for firms and households have remained broadly stable since our monetary policy meeting in March. However, market interest rates have increased further. While partly reflecting improved economic prospects, a sustained rise in market rates could translate into a tightening of wider financing conditions that are relevant for the entire economy. Such a tightening would be premature and would pose a risk to the ongoing economic recovery and the outlook for inflation. So against this background, the Governing Council decided to confirm its very accommodative monetary policy stance. We will keep the key ECB interest rates unchanged. We expect them to remain at their present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close to, but below 2%, within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. We will continue to conduct net asset purchases under the Pandemic Emergency Purchase Programme, well known as PEP, with a total envelope of €1,850 billion until at least the end of March 22, and in any case until the Governing Council judges that the coronavirus crisis phase is over. Based on a joint assessment of financing conditions and the inflation outlook, the Governing Council expects net purchases under the PEP over the coming quarter to continue to be conducted at a significantly higher pace than during the first months of the year. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with the countering of the downward impact of the pandemic on the projected path of inflation. In addition, the flexibility of purchases over time, across asset classes and among jurisdictions, will continue to support the smooth transmission of monetary policy. If favourable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated, if required, to maintain favourable financing conditions to help counter the negative pandemic shock to the path of inflation. We will continue to reinvest principal payments from maturing securities purchased under the PEP until at least the end of 2023. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. Net purchases under our Asset Purchase Programme, APP, will continue at a monthly pace of 20 billion euros. We continue to expect monthly net asset purchases under the APP to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. We also intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case for as long as necessary to maintain favourable liquidity conditions and an ample degree of monetary accommodation. Finally, we will continue to provide ample liquidity through our refinancing operations. The funding obtained through the third series of targeted longer-term refinancing operations, TLTRO III, plays a crucial role in supporting bank lending to firms and to households. Our measures help to preserve favourable financing conditions for all sectors of the economy, which is needed for sustained economic recovery and for safeguarding price stability. We will also continue to monitor developments in the exchange rate with regard to their possible implications for the medium-term inflation outlook. We stand ready to adjust all our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. So let me now explain our assessment in greater detail, starting with the economic analysis. In the first quarter of the year, euro area real GDP declined further by 0.3% to stand 5.1% below its pre-pandemic level of the fourth quarter of 2019. Business and consumer surveys and high-frequency indicators point to a sizable improvement in activity in the second quarter of this year. Business surveys indicate a strong recovery in services activity as infection numbers decline, which will allow a gradual normalization of high-contact activities. Manufacturing production remains robust, supported by solid global demand, although supply-side bottlenecks could pose some headwinds for industrial activity in the near term. Indicators of consumer confidence are strengthening, suggesting a strong rebound in private consumption in the period ahead. Business investment shows resilience despite weaker corporate balance sheets and the still uncertain economic outlook. We expect growth to continue to improve strongly in the second half of 2021 as progress in vaccination campaigns allows a further relaxation of containment measures. Over the medium term, the recovery in the euro area economy is expected to be buoyed by stronger global and domestic demand, as well as by continued support from both monetary policy and fiscal policy. This assessment is broadly reflected in the baseline scenario of the June 2021 Eurosystem staff macroeconomic projections for the euro area. These projections foresee annual real GDP growth at 4.6% in 21, 4.7% in 22, and 2.1% in 23. Compared with the March 2021 ECB staff macroeconomic projections, the outlook for economic activity has been revised up for 21 and 22, while it is unchanged for 23. Overall, we see the risks surrounding the euro area growth outlook as broadly balanced. On the one hand, an even stronger recovery could be predicated on brighter prospects for global demand and a faster than anticipated reduction in household savings once social and travel restrictions have been lifted. On the other hand, the ongoing pandemic, including the spread of virus mutations and its implications for economic and financial conditions, continue to be a source of downside risk. According to Eurostat flash release, euro area annual inflation increased from 1.3% in March to 1.6% in April and 2% in May 2021. This rise was due mainly to a strong increase in energy price inflation, reflecting both sizable upward base effects as well as month-on-month increases, and to a lesser extent, a slight increase in non-energy industrial goods inflation. Headline inflation is likely to increase further towards the autumn, reflecting mainly the reversal of the temporary VAT reduction in Germany. Inflation is expected to decline again at the start of next year as temporary factors fade out and global energy prices moderate. We expect underlying price pressures to increase somewhat this year owing to temporary supply constraints and the recovery in domestic demand. Nevertheless, the price pressures will likely remain subdued overall, in part reflecting low wage pressures in the context of still significant economic slack and the appreciation of the euro exchange rate. Once the impact of the pandemic fades, the unwinding of the high level of slack, supported by accommodative monetary and fiscal policies, will contribute to a gradual increase in underlying inflation over the medium term. Survey-based measures and market-based indicators of longer-term inflation expectations remain at subdued level, although market-based indicators have continued to increase. This assessment is broadly reflected in the baseline scenario of the June 2021 Eurosystem staff macroeconomic projections for the euro area, which foresees annual inflation at 1.9% in 21, 1.5% in 22, and 1.4% in 23. Compared with the March 2021 ECB staff macroeconomic projections, the outlook for inflation has been revised up for 21 and 22, largely owing to temporary factors and higher energy price inflation. It is unchanged for 23, as the increase in underlying inflation is largely counterbalanced by an expected decline in energy price inflation. HICP inflation, excluding energy and food, is projected to increase from 1.1% in 21 to 1.3% in 22 and 1.4% in 23, revised up throughout the projection horizon compared with the March 21 projection exercise. Turning to the monetary analysis, the annual growth rate of broad money declined to 9.2% in April 21 from 10% in March and 12.3% in February. The deceleration in March and April was due partly to strong negative base effects, as the large inflows in the initial phase of the pandemic crisis dropped out of the annual growth statistics. It also reflects a moderation in shorter-term monetary dynamics, mainly originating from weaker developments in deposits by households and firms in April, and lower liquidity needs as the pandemic situation improves. The ongoing asset purchases by the Eurosystem continue to be the largest source of money creation. While also decelerating, the narrow monetary aggregate M1 has remained the main contributor to broader money growth. Its strong contribution is consistent with a still heightened preference for liquidity in the money-holding sector and a low opportunity cost of holding the most liquid forms of money. The annual growth rate of loans to the private sector declined to 3.2% in April from 3.6% in March and 4.5% in February. This decline took place amid opposing dynamics in lending to non-financial corporations and to households. The annual growth rate of loans to non-financial corporations fell to 3.2% in April, after 5.3% in March and 7% in February. The contraction reflects large negative base effects and some front-loading in loan creation in March relative to April. The annual growth rates of loans to households rose to 3.8% in April, after 3.3% in March and 3% in February, supported by solid monthly flows and positive base effects. Overall, our policy measures, together with the measures adopted by national governments and other European institutions, remain essential to support bank lending conditions and access to financing, in particular for those most affected by the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains crucial, as a premature withdrawal of fiscal support would risk weakening the recovery and amplifying the longer-term scarring effects. National fiscal policies should thus continue to provide critical and timely support to the firms and households most exposed to the ongoing pandemic and the associated containment measures. At the same time, fiscal measures should remain temporary and counter-cyclical while ensuring that they are sufficiently targeted in nature to address vulnerabilities effectively and to support a swift recovery in the euro area economy. The three safety nets endorsed by the European Council for workers, businesses and governments provide important funding support. The Governing Council reiterates the key role of the Next Generation EU package. It calls on Member States to deploy the funds productively, accompanied by the productivity-enhancing structural policies. This would allow the Next Generation EU programme to contribute to a faster, stronger and more uniform recovery and would increase economic resilience as well as the growth potential of Member States' economies. In doing so, the programme would support the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in improving economic structures and institutions and in accelerating the green and digital transitions. We're now ready to take your questions. Thank you,
President Lagarde. And the first question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you very much for the opportunity. I have a question on the meeting. President Lagarde, may you tell us how was the discussion of the Governing Council meeting today? How was the mood? As you said, also the uncertainties remain. And what prevailed in the discussion as you decided to confirm the very accommodative monetary policy stance? Thank you.
Well, thank you for that open question, because it gives me a chance to tell you a little bit about how this meeting went. But let me start with what would be my takeaway of the overall analysis that we conducted, the joint assessment that we had, and the conclusion that we reached. I would say steady hand. And let me drill a little bit into that. We spent a lot of time looking at the quarterly staff projections and went deep into each and every item of those projections. And in conclusion of this work, I think I could say that we were somewhat more optimistic about the economy in the third quarter. And I think we took that sort of moderate optimism from the fact that, number one, we are seeing that the vaccination rollout has accelerated significantly and is increasingly outpacing other advanced economies' vaccination rollout. And second, we are seeing that containment measures are gradually lifted that should lead to a vigorous bounce back in that sector which was most affected, which is the service sector. So when we look at the service PMI, for instance, it is clearly now in expansionary territory. It went up from just marginal 50 in April to now 55.2 in May. Equally, when we look at the sentiment that is regularly published by the Commission, we are also seeing a sharp increase in May, actually the largest increase that they had ever recorded. And we expect private consumption to rise sharply as the containment measures are gradually lifted. So that's good news from the services point of view, which was most affected. Now, when we look at the manufacturing sector, which has earlier on been robust, it continues to be robust. And when we look at the Euro PMI manufacturing, for instance, it has stabilized at very elevated level to be at 63.1% in May. But we also looked into those supply-side bottlenecks that clearly have an impact in the short term on our inflation. particularly now, but for the short-term outlook as well. And that will create some headwinds, certainly. So that's all on the positive front. But we also acknowledged and looked into those uncertainties that we have on the horizon, which has to do with the evolution of the pandemic and how we see, little nest of revival based on another kind of variant. We are also dependent on how fast the containment measures will be lifted, particularly for those countries that are most sensitive to the service industry, the activities that are most a factor of social non-distancing. And clearly, if those containment measures are lifted early on, the tourism season, for instance, or a lot of the transportation activities will pick up. But that's an uncertainty as we look forward. So it's, as a result of that, that our staff increased their projection for 21, 22, and kept it at the same level in 23. So it's been revised up. Then the big job of the Governing Council after that, after it has looked deeply into our projections and what we see in terms of macroeconomic situation, our job is then to look at the financing conditions on the one hand and the inflation outlook on the other hand, because we do conduct that joint assessment, which we decided back in December, that we confirmed again in March, and which is our monetary policy reaction. So on the financing front, we clearly see broadly stable financing conditions taking together the corporate and the household sector. And there is a little bit of an increase in the corporate sector, which is clearly attributable to two particular countries. One is the Netherlands, the other one is Germany. And this is probably attributable to some, tactical approach taken by those banks in those particular countries to take full advantage of the TLTRO's conditions and to make sure that they catch up with the commitments that they have to take under TLTRO's. But overall, absent those particular factors, we see a little bit of tightening, very, very moderate though, but there is a potential that what we observed on the market interest rates actually could pass through or is at risk of passing through to the financing conditions that are applicable to the corporate sector in particular. For the household sector, not the case, because the financing of the household sector is at rock bottom at about 1.31% interest rate, which has never been so low. So this is the first part of the joint assessment. I'm happy to take you through the second part, which is also critically important, which has to do with inflation, but maybe that's too long an answer.
No, go ahead.
Shall I?
I'll leave to it.
Well, you're getting a really long answer for a really good question then. So we do the joint assessment, as you know, and we look on the other side at inflation. And as I said in the introductory statement, we are seeing some short-term improvement of the inflation number, and our assessment for 21 is 1.9%, which is clearly north of what we had in our last assessment. But I think we need, and we did that throughout our discussions, we try to really dissect what is underneath and what is the lasting impact of some of those factors. And I think that it's worth reminding ourselves where we were a year ago compared with where we are today, because that's how inflation is calculated year over year. And clearly, a year ago, a lot of activities went down. Prices were under downward pressure, clearly. And the down movement that we saw at the time has now and is being compensated by an upward movement that we see in many of those prices that went down. Clear example of that is the energy prices, where, if you remember, the price of oil and all derivative products went way down and has now recovered, and we see what we call that base effect between 20 and 21. This is clearly the case for it. We will see more of it, because there is another base effect that will be attributable to the German VAT. Back a year ago, July 1st, decline of VAT in Germany, deliberately in order to support the economy and sustain demand. Well, this has now been reversed, and we will be seeing the base effect in the months to come, which is probably a reason why inflation in some countries, Germany being one, will go north of our forecast for the whole of the euro area. But, and I mentioned earlier on the bottleneck issues, which will push certainly production prices up. But what we need to really focus on, and that's what we did, we need to focus on services. Our euro area activity is roughly 60% services. And services is predominantly labour. And we need to really dig down into the labour cost, into the wages increases, into the collective bargaining agreements that are reached currently and will be reached hopefully in the future. And in that respect, we don't see much by way of service prices going up. If you look at the many of the service industries, prices are not moving much. And that is because wages have not increased significantly. We see a little bit of movement, possibly, and we hope that we will see more of it and that more of the price pressures are actually channeled into higher wages. But we're not seeing much of that at the moment, probably because of the slack that we have in the economy. Let's not forget that, if you compare with back a year ago, a little more than a year ago, we have 3.2 million more people unemployed. And if you take the combination of the unemployed and those that are under furlough schemes, we're talking about 15% of people who are not on the job. So these particular aspects were really examined in great details to understand what is behind inflation, why it will impact significantly 2021, to a lesser extent 2022, because some of the base effect that I have described for you will begin to fade and will not actually have much of an impact in 2023. But, and that's a but, and it's important, and we discussed it at length, there's something that is moving a bit, and that is core inflation, when you take out energy and food. And on that front, there is a slight movement upward, which has now been repeated for a couple of months. And that's the reason why our forecast for core inflation has gone up a bit to 1.1 in 21, 1.2 in 22, and 1.4 in 23. We are far away from our ultimate aim, close to but below 2%, not there. And we certainly are not where we would like to be once the pandemic is over. But we are seeing some movement there, and we will continue to monitor that carefully. For the moment, certainly, headline inflations, temporary, specific factors that I have just described, and I have no reason to believe that it is going to last through and will be included in a rise in inflation that we would see in our medium-term projection. And that leads us to the decision. So that sorry if I was a bit long, but I have taken you through our deliberations throughout.
Thank you. And the next question goes to Alexander Weber of Bloomberg News. Alexander, please.
Good afternoon, President Lagarde.
Good afternoon.
So on the pace of the PEP, so the reference to the first quarter in the policy statement gives you a bit of flexibility. How much fluctuation in weekly buying should markets expect over the coming months, also considering that there's typically less liquidity in the summer? And the second question, if I may, so once the PEP comes to an end next year, inflation will be slowing down again, according to your forecast. At what point do you need to decide on whether to increase buying under the APP or take any other steps to boost inflation over the medium term? Thank you.
Well, thank you for your two questions. So that takes me to the decision, actually, that we made, which is to, as I said, steady hand. So we, based on the joint assessment that I have just described, what the Governing Council has decided, as I read in my introductory statement, is to expect net purchases over the quarter to continue to be, and I would like to quote the introductory statement for you, to continue to be conducted at a significantly higher pace than during the first months of 21. Significantly higher pace than during the first months of 21. Now, we're going to do that in the next 3 months according to market conditions, which clearly include seasonality. And we will do that with the very core attribute of PEP, which is flexibility. Flexibility across asset classes, flexibility across time, flexibility across geography, as you know well. So that's really what we will be doing. And this is done on the basis of, as I said, the quarterly joint assessment that is decided by the Governing Council, and then it's for the Executive Board to actually implement and deliver on the basis of this joint assessment and according to market conditions, including seasonality. On your second question, I'm afraid you'll be disappointed, because I might just very well refer to my Lisbon line. There's no point losing ourselves in conjecture. It's too early, it's premature, it's unnecessary to discuss those longer-term issues. And those matters have not been discussed by the Governing Council.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much, President Lagarde. I have one question on your comments that a sustained rise in market rates could lead to a tightening. So I think the market is kind of trying to find out where this threshold is. What is sustained and which level are you concerned about on average? And my second question would be on the outlook and the strategic review. Is my understanding correct that the strategic review will come first, and then you will try and come up with, not try, but then you will come up with a time map for the exit to the PEP?
You're going to be bored with me, but I'm going to repeat myself. Any discussion about exit from the PEP, as you just mentioned, would be premature, it's too early, and it will come in due course. But certainly, for the moment, it's too early and premature, as simple as that. We are in the process of a strategy review. We have been conducting this review for a while. It has been suspended, unfortunately, because of COVID-19 and the enormous amount of work that just landed on the shoulders of the very same staff that was working on the strategy review. So it's some would consider it undue long, and certainly we are working really hard to complete this process, and I hope that we'll be able to give the outcome of the strategy review in the second half of 21, and I still stick to that. But anything having to do with PEP and any kind of transition, exit, whatever you call it, has not been discussed, and as I said, it's just too early and premature. Now, concerning tightening, we conduct a joint assessment. The commitment that we made, the monetary policy decision that we made in March, which was in December and then in March, which was both critically important, is to make sure that we preserve favourable financing condition while also being very attentive to the inflation outlook with a view to resisting any downward pressure that would not help in returning to the inflation path of the pre-pandemic period. That's what we do, and that's how we conduct our monetary policy. So I cannot isolate one component. Financing conditions comprise a whole range of indicators from, as I said, financing conditions for corporates, for households, for sovereigns, market interest rates. We take the whole range of financing conditions, we assess that, and then we identify the inflation outlook, the various components, the likelihood, of our projections, and we come to a monetary policy decision which, as I said, is in a way a steady hand translation of what we decided in March.
Thank you. Next question goes to Balazs Korani of Reuters. Balazs, over to you, please.
Good afternoon, and thanks for taking my question. President Lagarde, did anybody at the meeting make the case for a phrase, a terminology different than significantly higher? Did they advocate some other option? And was the decision unanimous? The second question is about the underlying assumptions behind the projections. How did you factor in the Indian or Delta variant? Does your baseline factor in an increase in restrictions in the second half of the year, or do you expect restrictions to be gradually phased out? What are the projections for restrictions on the economy?
The proposal that is made to the Governing Council included the words that I have repeated, which you find in the introductory statement, which is the proposal to conduct purchases at a significantly higher pace than during the first months of 2021. And there was no alternative wording, and there was unanimous support for the introductory statement, and there was broad agreement over what was being proposed. Now, on the baseline and whether or not we take into account alternative variants and evolution of the virus, we will publish later this afternoon our scenarios, because we do have the baseline, and we also have a scenario that is the mild scenario and a scenario that is an aggravated scenario, if you will. And it's in those scenarios that you will find some of the hypotheticals that you referred to.
Thank you. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Lagarde, can you hear me?
Yes, I can. Thank you.
Thank you for taking my question. I have two questions for you today. Given that your medium-term inflation forecast for 2023 is unchanged and remains significantly below target, why are you not stepping up the pace of your purchases to achieve that? Or do you not think that increasing the pace of purchases even further would have any effect on inflation and the output gap in the economy? And the second question I have is on, you talked about bottlenecks and supply shortages. Presumably, given your inflation forecast is for a much lower inflation printout next year, you expect many of those bottlenecks to be cleared up by the end of this year. Is that correct? Thank you.
Thank you very much for your two questions. So on you're quite right that inflation forecast, inflation projection has been revised upward for 21 and 22 and not for 23. And that's for the reasons that I have explained earlier on. There's a base effect, there are some transitory factors, but there is also, and I have discussed that quite a bit, the movement on core inflation. So we are clearly seeing improvement, and that dates back to December, because our forecast for the core inflation outlook has been revised gradually, slowly, by 0.1% over the course of the last projection exercises. So I think that's certainly one of the reasons why we believe that the steady hand is actually the right response in the face of these improvements in core inflation, which we will continue to monitor very carefully. Added to which, you will have noted as well as the balance of risks, which was tilted to the downside in our last projection, is now considered as balanced. That's another signal that the situation is improving. On your second point, because you're right, we forecast inflation at 1.9 this year and 1.5 in 2022. And we assume in that respect that some of the bottlenecks that we know of at the moment, which the Financial Times has referred to in various articles actually, that some of those bottlenecks will gradually fade out, because it is a matter of the supply response. If chips are consensus around that.
Thank you.
And one second question, if I may.
Okay, you may.
It's about the digital euro. I would like to know if we are going to hear some news in July, as the market is expecting. It will be in the monetary press conference, or maybe in another conference or press conference.
Well, you will definitely hear about the decision that will be made by the Governing Council concerning the digital euro. But I just would like to warn you in advance that this is not, the final go. I think my colleague and board member Fabio Panetta has explained that very, very clearly. Mid-July, the Governing Council will approve to go ahead into an exploration phase that will include multiple aspects, from technology to privacy to inclusion and everything in between. So it's not as if the decision was final and made. Exploring all these matters will actually take a lot of effort, a lot of digging, and will bring together the whole euro system, because it obviously involves all the NCBs around the ECB on this matter. Yeah. But you will obviously hear about it. But all I'm trying to say is, let's not assume that we are jumping to conclusion. This decision will be, do we explore further, or do we not spend much more resources on this project?
And the next question goes to Mark Boindermann of NRC Handelsblatt. Mark, please.
Yes, thank you. Can you hear me, President Lagarde?
Yes.
Yes, thank you very much. You just said that the decision on the pace of purchases was broadly agreed. Could you perhaps sketch out a little bit how that discussion went, also from the point of view of those who were not in the majority, so the dissidents? And secondly, if I may, U.S. inflation just came in at 5%, which is high and also higher than expected. Do you view a risk or a possibility that U.S. inflation will trickle through to the Eurozone? Thank you.
Well, thank you very much. As I said, the Governing Council conducted this joint assessment of the financing conditions against the background of the inflation outlook, and then the decision was made to continue to purchase at a significantly higher level than during the first few months of March. And as I said, there was some debate about that, because obviously we had to analyze both the finance.
Street Journal. Tom, please.
Yeah. Hi, President Lagarde. Thanks a lot for taking the question. From this very aggressive monetary stimulus on both sides of the Atlantic. I mean, you see housing prices going up. Do you see any longer term risks emerging? And secondly, maybe on the U.S. comparison, you said that
the effectiveness, the efficiency, and the proportionality of our measures. And as a result of that, we have to look into the potential side effects, or the real side effects. And certainly, as far as we're concerned for the moment, the benefits that we have from the monetary policy decision that we have taken, going back to the beginning of the pandemic, back in March 2020, up until now, is that it largely outweighs the indirect effects that you're referring to. I would also add that in relation to some of those risks, there are alternative measures that can be decided either from a macro or from a microprudential point of view or from a fiscal point of view. But all in all, when I look at the counterfactuals, what would it have been? Where would we be had the European Central Bank not made the decisions that it made to make sure that we were not going to move and morph from a pandemic situation to a cataclysmic recession situation that we would have had? So I think that by doing what we did, we made sure that financing was flowing into the economy and that any risks of poor monetary policy transmission would be avoided. And by the same token, we also enabled fiscal policies to be supportive and accommodative as well. So it's the joint fiscal and monetary approach that was so critical in order to actually resist what could have been a very, very dramatic spin into a disastrous economic situation. So, as I said, I think that comparisons are odious, but comparing the U.S. economy as it stands and the euro area economy where it stands and as it stands, I think is not in the cards, because, as I said, we are, in terms of inflation, we're starting from a different base. In terms of fiscal stimulus in 21, different story as well. And in terms of point in the recovery cycle, not the same place yet, although clearly our vaccination rollout is accelerating and now clearly outpacing the vaccination cycle that the United States and other advanced economies are going through. So, of course, when you look at inflation, there are domestic factors, as I said, and we have to be attentive to the global situation. And how other economies, whether they are advanced, including the largest one, or whether they're emerging economies, how they are faring, and that as spillover effects or that as impacts. But are we exactly in the same point in the cycle? No.
Thank you, President Lagarde. That brings us to the end of the press conference. Thank you very much for following us. The next regular press conference is scheduled for the 22nd of July. Up until then, we wish you all the best, stay safe, and goodbye.